welcome financial professionals. I'm Jeremy Vidmar, Regional Vice President here at E4 Insurance Services, welcoming you to the Brew, building relationships every week. Thanks for tuning in. For those of you joining the Brew for the first time, welcome. We like to start the Brewcast by celebrating today's national days. So today is Skyscraper Day, along with U.S. Bowling League Day. So I don't know how those two connect, but maybe you can go bowling in a skyscraper today. Today we're kicking off September's Life Insurance Awareness Month lineup. I'm joined by Greg Spaeth, our Chief Strategic Initiatives Officer. That's a great title there. To discuss why Section 7702 was enacted, its key legal requirements, how it prevents misuse of life insurance for tax shelter purposes, and more. Thanks, Greg, for joining me today. We encourage you to use the chat box or raise your hand to ask questions. Reminder, all attendees are entered into a drawing for CE vouchers and a Starbucks gift card, and we'll announce the winner at the end. Thanks again for joining us today.
Thanks.
Yeah, Greg, I just kind of want to start it off. This was the Section 7702 was something that you brought up, I think, in one of the first meetings that you joined us here at E4, and It kind of a light bulb went off in my head. And as I was sort of thinking about this, recently my wife decided to buy my son a drone. So she went on to eBay and she picked out a drone. It was like $25 or something. And anytime you have like something like this, I'm like, okay, well, we're gonna get it. It's not gonna work, right? We got the drone, we got it into the house. I started flying it around the house and then flew it outside, and I was like, wow, this thing actually works well. And I use that as kind of a way to enter into this conversation, because I think sometimes when we're talking about protection plans, when we're talking about how they sort of work, what they're used for, sometimes we can kind of feel like we're buying a drone for $25. It's probably not going to work. And then once you get it and you're like, wow, this thing works a lot better than I thought, you're almost surprised. And I guess when you brought up the 7702 in the way that you talked about it, it just really, again, like enlightened me a little bit more and made me have a new appreciation for what Section 7702 is. So with that, Greg, again, I appreciate you joining us, and let's kind of just dive into the presentation and explain to us what is 7702.
Yeah, absolutely. And thank you to everybody. Jeremy, thank you for the intro. And I was a little nervous where we were going with the drones and 7702 planning. So, but for everybody, thank you for the opportunity to just talk about, this topic in general. I think sometimes, for me and in my 25 years of being in the industry, sometimes the misconception is what come into play. And what I'd like to do today is kind of set the table for everybody in terms of how do you differentiate yourself in your conversations with your clients about what 7702 is. And ultimately, you're trying to create a dialogue with them that's going to cause them to ask the question, what is it? So I've seen some financial advisors that use this question as part of their discussion, either on the front side, after they've done some fact finding, they find out how much, where the client's assets are at. And then second to that is on the back side of the conversation, right? After a discussion about where their assets are at. And there's a couple things that I would say that are the no-brainer, so to speak. But number one, you start with reviewing all of their assets and complement them. Some advisors don't do that, and we always say compliment them where they're at and ask them the questions about where they're trying to go. By knowing where their assets are at, it does lead to this question that I'm going to set for you, how you can ask it to your client, and then ultimately it allows them to have a response. So I'm going to use Jeremy as my example for this. So after a review with the client, you look at them and say, hey, Mr. and Mrs. Smith, thank you so much for sitting down with me. I've looked at your information, and you've done a great job at getting yourself on path to the destination that you want for your retirement. But there was one thing that I saw that was missing and potentially might be missing in your plan. Do you mind if I ask you a question? Who's currently managing your 7702 plan? So again, Mr. and Mrs. Smith,
Yep.
Great job on your plan. But I found one thing that might be missing in your plan. Do you mind if I ask you a question? Who is managing your 7702 plan currently? And what do you think the response is going to be, Jeremy?
What is a 7702 plan?
And that's exactly what you want them to say. That's exactly what you want, because ultimately you can do one of two things. You can say, hey, I'd like to, as part of our strategy in the next appointment that we're getting together, is talk about 7702 planning for you specifically as being potentially part of your overall plan. Okay. Or the second way is, hey, I'm so glad you asked that. Let's take a look at what that is, what 7702 planning is. Go out to irs.gov and you can type in 7702. And out on the site, it is going to tell you that it is cash value life insurance, right? It gives you an opportunity to educate your client about the guidelines that the government has put out there when it comes to different types of plans. So think of it this way. What section of the IRS code is 401k, Jeremy?
I'm going to guess it's 401k.
Correct. And what about 403b?
Maybe 403b.
Yes.
You're laying these up for me. These are easy questions, but okay, let's go.
That's the goal, right?
Yep.
But ultimately, the client is going to want to know and understand why would you coordinate something like this or correlate 401k, because it is in the IRS code as 401k. And when you put in title search 7702, it brings up cash value life insurance. See, ultimately, people can be and may have a misconception about what life insurance is. And the goal here is to educate them not about what it is, but what it could potentially do for them. I'm going to do one thing. I got to grab something.
You got props? Did you bring props?
I dropped a mouse.
Oh, gotcha.
It was sliding here.
Yep.
So ultimately, the question is, what is 7702, right? It's the section inside the IRS code that defines what qualifies as life insurance for federal tax purposes. And it ultimately ensures that life insurance policies are not an investment vehicle. It is a life insurance, but maybe using the term like asset class, right? It's another asset class that gives you some and receives some tax advantages. So why was Section 7702 created? Back in 1984, there was a law that came out, was a deregulation, and ultimately what was happening is individuals were taking a life insurance policy and stuffing as much premium in. So they might have like a $100,000 death benefit, and they're putting $1 million in there. And ultimately, the government started looking at that as a way of avoiding taxes in the future. So tax avoidance is not a good thing. That can get you a 5 to 10 year plan in the prison. So the government wanted to make sure that they put up some guardrails in order for individuals not to do that. As long as the policies meet specific criteria, with the death benefit proceeds being tax-free, and you still have tax value build up inside, or tax deferred build up and tax-free access to that cash if properly designed. Ultimately, what are the requirements? And this is the section where I asked Steve Berge, who is the SVP of our Chief Design Specialist, to kind of come on with us to talk a little bit about, there's 2 tests that you need to look at. But first, the policy must be a permanent policy. So whether it's a whole life or a universal life, has to meet one of those 2 criteria. And folks, we've gotten asked questions in the past, does variable life? Yes, because it's a universal life. It does follow these same guidelines. Secondary to that, the satisfaction of the test. One is called the cash value accumulation test, which you might hear the acronym, because in the insurance industry, we don't have enough acronyms. CVAT, yep. Right? And then the second test is guideline premium and corridor test, or GPT. So Steve does a lot, and his team do a lot of illustrations for advisors that we work with throughout the United States. Steve, could you give a little bit of a background in terms of, when you use one test versus another test?
Sure. Thanks, Greg. typically what we do and what we see for these types of designs, the cash value accumulation test, we typically will use when we're trying to stuff a lot of cash in early on a lot of cases, a level death benefit to keep that death benefit as low as we can with as much cash as we can early on. We usually see that if we've got maybe a larger lump sum coming in the first year, that we want to try to squeeze in, maximize the growth with a minimum death benefit, but still be able to keep that premium in relation to the death benefit as high as we can, so that it grows later on. The guideline premium, we typically see that a lot on the retirement type of design plans, where we're using an increasing death benefit. Maybe it's paying a 10 pay or pay to 65, those types of designs. And we're a lot of times utilizing that with the carriers, especially the ones that have the overload protection, just because the GPT in relation to that, a lot of the carriers only offer that with the GPT design. But every plan is a little different. We're always running both to see which one is going to maximize the cash value down the road and what we're trying to accomplish with the plan.
So Steve, in general, so the GPT typically is more of an income play. Would that be correct? And then the CVAT more of a death benefit guarantee test.
Yeah,
right?
That is going to be more of a design where we're trying to build cash in it, but we want it to hit corridor and push that death benefit later, push it up later on in the policy.
Perfect. Well, if anybody has questions about wanting to get into the details about how each one of these calculations work, there are carriers out there that do give, and I've actually got a frequently asked question from Symetra that actually will go into the details on how they actually do the test. But I don't think today is about getting inside the clock to see how the clock works. It's more about telling time in terms of how do you work with your client? What are you trying to accomplish with them? Are you trying to do some kind of death benefit guarantee further out, increase the death benefit, or are you looking for some type of income? But there are resources. So reach out to your RVP, reach out to Steve's team, and they can email out that information if you have somebody who is asking more questions about that. Perfect. Thank you for that. The last item is overfunding a policy. So if you overfund a policy $1 over over CVAT or GPT, what happens to the policy? And they call that a MEC. Right? We need more acronyms.
Another good acronym for us. Yep.
Yes, we need more of those. So the modified endowment contract, ultimately, at a very high level, what does that mean to you and what does that mean to your client? You still have death benefit proceeds, that's income tax free, but the other side of it is you don't get the advantages of when you take the money out, that it can come out tax free. So you might have heard more acronyms, LIFO and FIFO. So this would be what we would call a LIFO, last in, first out premium is going to be taxed. So you'll get a 1099 at the end of the year if you actually create a modified endowment contract. All right, moving on. What are the advantages for a client by doing 7702 planning? Number one, you get tax deferred growth, right? The cash value grows tax-free with inside the policy. In my past, we've done a lot of index universal life. Some of the clients, they want a little bit more of the sizzle from the market, but they don't want any of the risk. And that's an area and an advantage that they can take now in today's environment. There are so many different carriers with so many different options. That's why you want to contact your RVP, contact Steve's team to really say what option is best for my client. Because just like my children, all 5 of them, they're uniquely different. And just like your clients, they're going to be uniquely different in the sense of the design that you're going to want to use and the carrier that's going to meet their needs. Secondary, tax-free loans from a life insurance, if it's properly designed. And also think in terms of what if there's an emergency, right? Your client might already be doing some type of retirement planning, and they didn't get to 59 and a half, and they need to have access to some type of an emergency fund. Well, guess what? With cash value life insurance, 7702 planning, you have access to that cash. And guess what? You can actually pay yourself back if you took a loan from, from your own policy, whether that's a car, whether that's some type of an emergency that comes up on your home. You actually have access to that. It's a nice little feature that 7702 planning does for your clients. And finally, income tax-free death benefit. As always, cash value life insurance or permanent policies, it's all about the death benefit and death benefit planning, for the client and their needs, whether that's income replacement, estate planning. It's a great feature to have, and it's paid to the beneficiary outside of probate. Anything else you'd want to add on there, Jeremy?
No, I don't think so.
Awesome. And then finally, what are the benefits to you as an advisor by adding this one question into, your review with your clients? Well, number one, I believe that it differentiates you and offering an advantage, and tax advantage strategies for your clients. What you're doing is you're repositioning the assets more tax efficient by using 7702 planning. And ultimately, we don't know what is going to happen with taxes in the future, but our government does a great job at spending with a $37 trillion deficit. I don't think there's very many people that are going to argue that taxes are going to continue to go down in the future. At some point in time, Uncle Sam's going to want, his dollars. So by using this strategy, it's really helping your client to anticipate what could be happening in the future. And it also appeals to the clients being in control, right? Seeking another source of income for themselves, the legacy planning that you get, and then, ultimately repositioning the assets. So I think it does this for you as an advisor with your clients. And probably one of the most important things is it creates a more, beneficial relationship between you and the client in future conversations. There's many statistics out there that you can look up about doing business with one product with a client allows you to retain them by about 40 to 50% year over year. By adding another 2 or 3 different products that you can offer, which 7702 planning can be, you can increase that up to as high as 95% and above. Really, the important part about this is by doing this type of planning with them, you're really making that next generation whole in terms of any future tax, obligations they might have after their death. And if you're trying to retain assets under management, it's a lot easier instead of just delivering the assets with a tax bill, but the assets with that tax bill and showing them how you position 7702 planning to actually help offset the taxes so that the beneficiaries are whole. And I think you got a better chance of retaining, the future clients with that. All right.
Just on that point,
Yep.
Greg, I just kind of want to say it. I mean, when you say it differentiates you, and the number of advisors that I ask, when do you lose clients? And we know the statistics are number one answer that everybody gives is what? I'm going to put a question to you, I guess. When do they lose their clients?
At death.
Yeah. So when one of the spouses, one of the 2 spouses
Yep.
dies, and ultimately when the second one dies. But then I've also got the answer as well, is it's when the annuity guy, when the life insurance guy, when somebody comes in and they're sending out postcards, they're running events, and they're bringing them to it. Inevitably, then assets go out the door. And so talking to them about 7702 planning gives you an opportunity, even if it's not the right situation to place it in, it lets them know that about this kind of planning, and then it keeps clients. I mean, they're not going to go to the people who are putting on the seminars, and taking your clients and their assets. So yeah, that's, again, when I heard 7702 plan, it just like, all right, it makes you present to your client that I really know more than just what I'm, than the run of the mill stuff that we're talking about. So.
Well, and I think with using the question of 7702 portion of your plan, it does allow for you to, without some bias coming into play because, hey, I want to talk to you about your life insurance planning. Well, okay,
Yep.
they don't understand, they're not in the industry. They may not understand fully that here are all the benefits that cash value life insurance actually brings you. Why would you not want to take advantage of that? If the government puts restrictions in place, puts guardrails up, should you take a look at that, educate your client about how to take advantage of it, and then ultimately, you've educated them to be able to make a decision that ultimately, does this make sense for me and my family at this time?
Yep. Very good. Well, again, I just want to remind you guys, you can use the chat box if you have any questions. Anything else, Greg, or
No,
just move
and
right in?
yeah, I do have one thing.
Okay.
Just like playing sports, using this kind of question with a client, I would highly recommend reach out to your RVP and run it by them on how you would ask it. Because again, like I said before, you can add it on the front end of a review with a client, or you can add it right before you're ending a review with them. But I would highly recommend practice makes perfect. It makes it a lot easier for you. And I know that anybody on the team at E4, even if you needed to reach out to me and you wanted to run it by me, I'm more than willing to do that because I love creating dialogue that is unique and different and actually creates a better, more intimate relationship with you and your client.
Excellent. But as we wait to see if there's any questions that come up, I'd just like to remind everyone that today's brew and our entire library are recorded and shared on the brew page on our website at www.e4.insurance. Don't forget to subscribe to our YouTube channel to keep up with all brewcasts. They're released every Wednesday. So I don't see any questions coming up. So we're
Does
going to
that
go
mean
right
we did
in.
a really good job?
I'm not sure, or they want to call us afterwards.
That's right.
For a giveaway, Greg, I need you to pick a number between 1 and 16.
1 and 16. Let's go with the number 3.
Lucky number 3. All right, our winner is Carmen Blooms. So I think I know who Carmen is. Congratulations. Be on the lookout for a complimentary CE voucher and a Starbucks gift card. You can use that up in Minot. That'll be coming your way from all of us here at E4 Insurance Services. Our next brew will be released at 10 o'clock next Wednesday. Join me and Matt Reddick, Business Development Vice President at Nationwide, as we run through a unique tool and see how life insurance might be a more affordable option for your clients. Thanks, everyone. We'll see you next week on The Brew.